Thank you for joining us today at what we anticipate and hope will be a dynamic and informational presentation on the Tax Cuts and Jobs Act and the many sweeping changes which may affect all of you. For those of you who do not know me, I'm Bob Sharon. I am the tax leader for Friedman. And here at Friedman, we've been closely monitoring the tax developments ever since President Trump's election last year, and we are pleased to bring you timely presentations such as this one. As a leading provider of accounting and tax and business consulting services to public and private companies since 1924, Friedman prides itself at being at the forefront of changes that can impact our clients. To that end, recently, we have launched a cybersecurity practice, Friedman Cyzen LLC, in response to evolving and heightening cyber threats, to be able to bring peace of mind to our clients and to empower them with a sense of cybersecurity and defend against attacks. Jake Lehman is the managing director of Friedman Cyzen. He's here with us today, and should you wish to speak with him after the presentation. Today's presentation will give you a better sense of the Tax Cuts and Jobs Act, what it means to you and your business. TCJA, as it is referred to, is the most significant piece of tax legislation to arrive in the last 30-plus years. Was it a good thing or was it a bad thing for you? Well, before we dive in, here is a hint. Here is who is happy with this. C corporations, certain pass-through organizations, people who use the standard deduction, parents who send their children to private or religious schools, businesses that rely heavily on equipment to generate profits, and estates between $10 to $20 million. But there's a lot of us who are sad. People who high state tax residents, such as people here in this room, Pennsylvania, Connecticut, New Jersey, New York, employees who deduct business expenses, individual investors who pay advisory and management fees, victims of casualty losses, clients who move around a lot for business purposes, people who spend money for entertainment in their business, home equity debtors, individual litigants who sue and receive money but cannot deduct legal fees now, and taxpayers with losses to carry back to profitable years. Now, I've just scratched the surface. Today, Kim Dula, tax partner from our Philadelphia office, will cover the highlights and lowlights of individual tax reform. Mike Greenwald, leader of our Business Entity Division, will tell us why most businesses are happy about the new tax law, and Ryan Dudley, our chairman of Friedman's International Tax Department, will discuss the implications to individuals and businesses conducting operations and investing abroad, as well as foreigners doing business in our country. During this presentation, we're going to offer some preliminary planning thoughts. It is important to realize that this new law is yet to be a month old. There are no regulations that have been promulgated. No one at the IRS is willing to take our questions, and there's no guidance from the IRS. So while it is tempting to jump into complicated structures and changes in the way we do business to save some current tax dollars, we at Friedman do not advocate letting the tax tail wag the dog. Bifurcating your business into separate pass-throughs or switching an S-corp to a C corporation could be analogous to marriage and tax shelters. Easy to get into, hard to get out of. During the next few months, we will be formulating tax strategies, performing calculations, discussing with our clients what they should be thinking about in the brave new world of tax reform. While we work with many of you here today in some fashion, for those of you who aren't clients of Friedman, today we'll give you a taste of what it's like to be part of the Friedman family. Our mission is to help empower you to reach new levels of success. As you may have seen earlier, we have several of our tax specialists walking around the room to help address specific questions that you may have. We encourage you to reach out to our specialists. Along with the panel, we'll be sticking around after the presentation for a bit to talk with you one-on-one. Please note that we have question cards at the tables. We'll be collecting those, and we'll be answering some questions afterwards. Alternatively, during the presentation, you can email me. My email address is on the tent cards on each table. We would ask that you silence your phones. during the presentation. That would be helpful. As a reminder for those of you who are seeking CPE credit, please make sure that you signed in at the registration desk, and we would also appreciate if you could complete the evaluation form. Well, with that, I'm going to turn everything over to Kim Dula, who's going to talk about individual tax changes for the new law. Kim?
Thank you, Bob. Good morning, everyone. I'm going to apologize up front. With regard to the individual changes, there's so many that it's going to sound like I'm literally reading a bullet point list, which I am. It's literally a bullet point list, but I want to make sure there's so many important changes that at least they get mentioned. We may not go off on tangents about them, but I think it's important for at least everyone to understand that something has changed. Before the event started this morning, I bumped into one of my colleagues and we were talking about how, with regard to this tax act, it's almost as if people who are just getting into the tax industry are at a great advantage compared to all of us sitting up here. So much of what we know and what we've experienced over the last 20, 25, 30 years is almost meaningless at this point. So much has changed that when you look at the Tax Act, you almost have to look at the act, take it for what it is, and if something specifically isn't mentioned, go back to the tax code and just assume that that hasn't changed. So you're almost working with two different sets of books right now as you're trying to interpret all this. So it's going to be a crazy ride over the next 12 months, and hopefully, at least this morning, we can, all just join in together and learn, take away a couple little takeaways here or there. So anyway, with regard to the, individual taxation, this was the one area, at least for me in my practice, that I was hoping we would see simplification. That's what we heard so much about. Tax reform was going to be about simplification. We had 7 tax brackets before. We still have 7 tax brackets now. The good news is the brackets have decreased. So we went from a highest tax bracket of 39.6, now we're down to 37, which is great, and it's very good news. And keep in mind, as we're talking about all of this, some of the provisions that we discuss start in 18, end in 2025. So they expire in 2025, should something not change between now and then. Some things affect 2017, some things don't take place until 2019. Again, all the reason why every time you have a question, you have to go back and look and see when it starts, when it ends, and when things just automatically apply. But these tax brackets go into place for January 1st, 2018. One important takeaway, I think, is where the highest brackets would have started and where it does start now. So for 2017, the 39.6% bracket for married filing joint folks would have started around $471,000. But now that 37% bracket will not kick in until those with taxable income over $600,000. So that's definitely a benefit for many. For single filers, it would have kicked in at 39.6% at around $418,000. Now we won't see the 37% kick in until until $500,000. So again, some tax benefit. Trusts and estates is something else that was touched by this. To get into the 37% bracket for a trust, it will only take you $12,500 worth of income. So for those of you in the room who work in the trust area and with trust planning, planning will still be needed if it makes sense to pull the income out of the trust and make use of individual brackets of beneficiaries rather than keep it all within the trust itself, because it's not going to take very much income to get up to that top bracket of 37%. The next item that's changed is the standard deduction. Again, doubling of the standard deduction for many. For married filing joint, we're going to see an increase in standard deduction to $24,000. For head of household, up to $18,000, and for everyone else, $12,000. So many people, when there was discussion about the standard deduction change, said this doesn't apply to me, I itemize. Who cares? I'm not going to benefit by it, doesn't really matter. I think we're actually going to see more individuals taking the standard deduction than ever before, only because, a few reasons for that, because the amount is so high and because we lost so many itemized deductions, as we're going to talk about later. So people who may not have ever taken the standard deduction before may just fall into that category of taking it because they now don't have the state and local income tax deductions and the miscellaneous itemized deductions. That's a big change.
Jim, in that regard, how do you think that's going to affect charities?
I mean, personally, I think and I could even speak for one of the charities where I sit on their board. It's a grassroots charity. It's not, a larger charity. It's not a United Way or an American Red Cross. It's a small grassroots charity in Philadelphia. They are extremely concerned. They get their funding from small $500, $1,000, $2,000 contributions. That's what makes up this entity. That's what funds this entity. And it's because of people who at year end say, wow, I didn't contribute much to charity this year. Who can I give to? And they'll send those $5,000, $1,000, $2,000 checks. Now people may think, well, I don't really have to do anything, and I'm going to get a deduction for $24,000. So I think many of our smaller charities and the larger ones as well, they're going to be impacted by this change. Personal exemptions have been eliminated. For many of our taxpayers, this doesn't mean anything because of the alternative minimum tax phase out and income phase outs. Exemptions may not have meant much, but to those mid-level taxpayers, the exemptions for a family of a husband, wife, and 3 or 4 children, it's meaningful dollars. But those exemptions are now gone. They're completely eliminated. Kiddie tax is modified. This is a big change and something that wasn't really, you don't read much about the kiddie tax when you're reading about articles, but kiddie tax applies to those of us with children who have unearned income in excess of about $2,000. That unearned income was taxed at the parents' ordinary tax rates. So this created a need for extensions. If the parents went on extension, the children had to go on extension, and you had to wait until the whole family was done, until the returns got finished. Now we won't have to worry about that because that's been split apart. But what will happen is the earned income of these children will be taxed at single taxpayer rates, and the unearned income is going to be taxed at the trust rates. So keep in mind what I said before about trusts and the trust tax brackets. It doesn't take very much, a little more than $12,000 of income to get to that 37% bracket. So if you have children with unearned income in excess of $12,000, they could be looking at a tax bracket of 37% on that money. So both good and bad news. Capital gains in general and how they're taxed, including or qualified dividends, no change. So we're still going to see ourselves with the 0%, 15%, and 20% tax rates for capital gains. So that's good, nice, easy, not much change there. Alternative minimum tax, we were all hoping, myself included, sitting with fingers crossed, that we were going to see AMT repealed. For business purposes, they got one response. For individual purposes, we did not. So we still find ourselves having to deal with the alternative minimum tax going forward. The good news is the exemptions for the alternative minimum tax have been increased somewhat. For married filing joint folks, they're going to see themselves with an exemption of about $109,400. The better news to that is that exemption will not start getting phased out for married filing joint folks until you're over the $1 million income threshold. So that's a good thing because that phase out of that exemption started much sooner based on our old rules. But based on the current Tax Act, that exemption is going to stay intact for many, many, many more people, which is good. Quite frankly, though, what is given, many people may not understand, especially many of our clients, is that yes, sure, the alternative minimum tax may not impact you now because of this, but it also may not have impacted you anyway because Congress took away your deduction for state and local income taxes, which is what threw you an AMT to begin with. So with or without this, AMT may not have been a consideration. All the more that we find ourselves running projections and doing analysis because we can't just give every client a blanket answer. We have to look at everything. Every single person's circumstances are just so unique with what they have. The healthcare mandate has been eliminated. So for those of you who are involved even for your own 1040, there's a checkbox on page 2. do you and your family have coverage for the entire year? If you weren't able to check that box because you didn't have adequate coverage for the entire year, you could have possibly faced a penalty. That individual health care mandate has now been abolished, so I would imagine that checkbox is going to go away. But what many people thought is that when that mandate went away, what's going to happen to the net investment income tax that we've all grown to love at 3.8% of our net investment income, and what's going to happen to the Medicare surcharge, which was added a few years back at 0.9% on our earned income. They stay. So they're not going anywhere, so we're going to, keep on going with those, and no changes have been made to them as well. So we're still with the same rules, 3.8% for our net investment income and 0.9% the Medicare surcharge on our earned income, okay? And same income limits as well apply. As we mentioned before, the state and local taxes have been severely limited. Can't say they've been eliminated, they haven't. They're just now capped at $10,000. So that means your state and local income taxes, your real estate taxes. If you happen to be in the state of Florida and you were taking sales tax rather than income taxes, all of that is now capped at $10,000. This is what was creating the complete and utter insanity before year end. Clients who never ever want to pay tax were now calling saying, what can I possibly prepay before December 31st? I had clients saying, I know I'm going to owe $200,000 to the state of New York for 2018. I'll pay it all. I'll just start writing checks. So we had to look into that, and the act is very clear with regard to the income taxes. In order to get a deduction for 2017, it will be based on taxes paid before year end, income taxes paid before year end that were for or projected to be for 2017. So for that particular client who wanted to prepay literally 3 years of taxes in order to ensure he was getting the deduction, that was not possible. Other questions that we were getting were with regard to real estate taxes and people who wanted to prepay those before year end. Now again, for the folks who will continue to be in alternative minimum tax for 2017, because that is still a factor based on the old rules for 2017, it's not going to help them one way or another. Many felt, I don't care if I'm projected to be an AMT, I want to pay it anyway, just in case, because I know come 2018, it's gone. I'm not going to get this deduction. So for those folks who were trying to figure out what can I prepay, there's been a lot of back and forth, and there's been a lot of articles, and people are talking about case law now. What could I possibly have deducted for 2017 for real estate taxes? And I think for the majority of us here, the consensus is the real estate taxes had to be assessed in order for you to be able to take a deduction for 2017. And obviously those real estate taxes had to be paid by year end. Well, what's the definition of assessed? What does that mean? Did you actually have to have a bill in hand? All of that kind of stuff. There's a lot that's out there on this, but many of our clients, again, at the end of the year, we're trying to prepay as much as they possibly can before December 31st. So these are just some of the calls and things that we were dealing with. The next item is the mortgage. Does anybody want to comment on?
Yeah.
Mike, I know, is dying to chime in.
A couple of comments.
I could see people looking at me.
Yeah, I'd like to comment on that. The IRS's position was that the tax had to be assessed. There are different things that happen in different states. One of the important things to look at if you did prepay the tax, obviously there's nothing you can do about it now, but is what's the lien date? In other words, when does the actual tax liability attached to the property? Not what's necessarily the assessment date, but what's the lien date, because that typically is earlier than the actual assessment, the actual bill that you get, or the actual entry onto the tax rolls. So there's some questions about that. There's also questions about, for example, if a co-op, and I've seen arguments going both ways on this, some commentators think that co-ops, particularly those that are on an accrual basis, can't prepay the tax and take the deduction because of what's called the all events test, and that the accrual has to be for the year for accrual basis accounting, the year in which the tax liability is actually due economically. There's other commentators out there, and we could get really deep in the tax weeds on this, that argue that co-op taxes are not actually in the same code section as property taxes for individual owners of real estate, so that if the co-op were to prepay it, it's not covered by this $10,000 limitation anyway, which would argue further that even going forward, that if you have a co-op and it's paying property taxes and then allocating it to the tenant shareholders, that it might not even at that point be subject to the limitation. So again, Kim said this is all tax simplification. We can get really deep in the tax weeds, and I can find you whole bunches of reasons why it's clear as mud.
Clear as mud.
Clear? That's an inside joke.
Yes, it is. Okay, moving on to the mortgage interest deduction. This was a big thing for many people, especially those who were looking to buy right before the end of the year. So before the act, we were looking at acquisition indebtedness or mortgage interest on acquisition indebtedness that was deductible as long as the the acquisition indebtedness was $1 million or less. That $1 million has now been reduced to $750,000. There's also no deduction now for home equity indebtedness. Many people, it was the first $100,000 of home equity debt you can just deduct. It didn't matter what you spent the proceeds on. In any respect now that the home equity indebtedness deduction is completely removed. What hasn't changed though, and there was talk, it may have been both in the House and the Senate bills, was changing the $500,000 exclusion on the gain from your sale of your principal residence. That has not changed. So those rules still apply. The first $500,000 of your gain on the sale of your primary residence, as long as you owned and occupied it for 2 of the last 5 years, will still apply as it was. Again, if it's not mentioned in the act, then the old rules applied. So we have to keep that in mind as we work through all of this. Be careful with things like refinancing and just when they occur and cash out. Interest tracing rules, all that old stuff is still going to apply with regard to your mortgages. But just keep in mind, it's the $750,000 has now replaced the $1 million. Okay, another item that I do want to bring up, there was talk, and I know I've gotten phone calls about this, about changing how people can utilize tax lots of their securities that they had. I know years ago I had many clients who were executives with Under Armour, and so because of their stock options, they had all these different lots of securities that they were building up, and we would do planning in order to figure out which lots they should sell at what time in order to be able to utilize certain cost basis. And there was talk during the whole time that the act was being put together in both the Senate and the House bills as to removing that flexibility so that you had to use the tax lots or the security lots based on a FIFO basis. So removing planning, that never happened. So just to be clear, that's not mentioned in the act, so we still have flexibility there. You can still choose the security lots that you plan to sell when you're planning and you're doing any sort of capital gain investment planning. The medical deduction, again, big talk about completely eliminating that, which would have hurt many of our elderly clients or clients who just find themselves in horribly unfortunate situations with large medical deductions. The medical deduction actually will stay in place, and actually the 10% that applied to many will now be reduced to 7.5% of adjusted gross income. That 7.5% AGI threshold or limitation will apply to all taxpayers, not just those 65 and older, but anyone who can take advantage of the medical deduction. With regard to charity, as many of you know, when you're taking a charitable deduction, there are different adjusted gross income limitations. Your normal, regular cash contribution, which is at a 50% of adjusted gross income limit, will now be a 60% limitation. So our 50% charitable contributions will now be 60% of adjusted gross income. Again, I had a client call the other day who has a significant amount of contribution carryover at the 50% limit. And the question was, now does it become, going forward, 60%? Based on my read of the act, absolutely not. It will retain its 50% character going forward, and then it will be for contributions made after January 1, 2018, that the 60% limit will apply. Miscellaneous itemized deductions are eliminated. Again, this is a big one, as Bob mentioned right in his opening. Tax preparation fees, now not deductible. I have to explain to clients, haha, you weren't getting them anyway because you were an AMT, but not deductible. Investment expenses, not deductible. Unreimbursed employee business expenses, that's a big one, Form 2106, again, eliminated. Any miscellaneous itemized deductions are now gone. So those who weren't in AMT and that found themselves being able to take advantage of many of these, and many of our clients can take advantage of everything, they have been completely eliminated. The overall phase out of the itemized deduction, what is known as the Pease limitation, very generally speaking, about 3% of a certain amount, over a certain amount, you would have to start phasing out your overall itemized deductions, okay? That limitation is completely gone. So now, for those of you who work with a tax practitioner, are tax practitioners, do your own tax return, when you foot the Schedule A come 2018, those numbers are actually going to foot down because there is no limitation going forward. Well, going forward until something changes. Alimony. In prior years, well actually when I say in prior years, for years beginning or for agreements that are executed after December 31st, 2018, so beginning in 2019, there will be no deduction for the payer of alimony. And the receiver of the alimony will not be including it in income. So this is going to change many agreements, I'm sure, going forward. And for those who work in the divorce area and work through settlements, there is a lot of tax planning that goes into play for those folks who are working through settlement agreements in divorce situations. So this will change many of those agreements and how they've been drafted in the past.
Also might accelerate some divorces.
It may. It may. It may. Who says accountants aren't funny? Come on, they're funny. Okay, moving expenses. Moving expenses have been completely eliminated, but keep in mind, so what comes with that? Because many moving expenses were deductible, employers were allowed to exclude moving expense reimbursements from their employees' W-2s. It was not considered taxable income. Now that those moving expenses are no longer deductible, they will now be taxable to the employees if they're getting reimbursed for them. So that's a big takeaway, and that's something that many businesses and payroll departments need to be aware of. Changes to the child tax credit. Again, many people hear child tax credit and they think, will never apply to me. The amounts, the thresholds to take advantage of the child tax credits are so low. But the child tax credit is still in place. It has increased from $1,000 to $2,000, but what has also increased is the phase-out limits have increased. So for married filing joint, in order to be able to take advantage of the child tax credit, it's a $400,000 threshold. So it's higher, it's much higher. So many more people are going to be able to take advantage of that. All other taxpayers will be limited at $200,000. There's going to be a refundable component, and there is also an additional $500 credit that could be available for non-child dependents. So just keep in mind, don't poo-poo the whole idea of the child tax credit and it doesn't apply. It may. The rules are different going forward. I say in most cases, personal casualty losses, theft losses are eliminated. There will be, obviously, if there is ever declared a federal disaster or something like that, where it could come back into play, but generally speaking, personal casualty and theft losses have been eliminated, no deduction. A change to the 529 plans. Beginning in the year 2018, people can now take $10,000 per year and choose to use that $10,000 distribution for elementary or secondary schools. It could be public, private, religious, but $10,000 per year from a 529 plan can now be used to fund, like I said, elementary or secondary schools. So not just colleges, universities, things of that nature that we're all used to.
But be careful with that, because 529 plans are really governed in large part by state regulations. And each state is different. So not all the states have caught up yet with the federal provision. For example, New York still doesn't have a provision in their 529 plan to allow for you to take that $10,000 out without other tax ramifications in the state for using it for K through 12 education. So again, till the states catch up, there's going to be some some planning that's going to need to be done and some consideration taken into account that there could be a state tax impact from doing that. On the other hand, it's a particularly interesting planning tool if you can overfund your 529 plan. And if anybody, has young kids and wants to talk about that, Kim and I can talk about the benefit of that with you afterwards.
Okay, now moving on to estate tax. Although there's not much in the act itself about the estate tax, what did change is a big deal. So the exclusion amount, what many people call our lifetime exemption amount, which was roughly about $5 million going into 2017, has been doubled now to 10. So we went from 5 to 10. From an inflationary perspective, what this means is that each person going forward, beginning in 2018, has a lifetime exemption of $11.2 million. For our married filing joint couples, that now means 22.4. We always say for our married filing joint couples because portability still remains, meaning that if you have the first spouse passes away and all of their lifetime exemption has not been used upon the first death, a tax return gets filed. And then there's a portability section on the 706 form where you can then port over the remaining lifetime exemption from spouse 1 over to spouse 2 so that they can use that. So portability is still in play, and it's something that's extremely important. Generation skipping tax, just real quick, stays, obviously, and is still tied to the lifetime exemption amounts. And the annual exclusion itself, which wasn't impacted at all by the act, is $15,000 for 2018. Annual exclusion, just very generally, everyone each year is given an annual exclusion amount where they can gift up to $15,000 to as many people as they want without eating into that $11.2 million lifetime exemption. But that amount for this year is $15,000. Just getting on my soapbox a little bit with regard to estate tax planning, so many people hear that this has increased so much and now think, I don't need any estate planning, my estate is nowhere near that. Don't forget, with regard to anything that we're talking about today, this is all federal. That doesn't mean the states are going to follow. So states like New York, the exemption is what the exemption is, and planning still needs to be done. States like, I'm from our Philadelphia office, many of my clients are dealing with the state of Pennsylvania. We still have an inheritance tax that could have a high rate to it depending on who your beneficiaries are. There's still planning that needs to be done. And as we all know in this room, you don't just do estate planning for tax purposes. I sort of get a little nervous because sometimes it takes clients so long to pull the trigger on estate planning itself. And if taxes couldn't do it, now if tax isn't the driver, will there be enough of a driver to have clients continue to focus on the importance of having an adequate estate plan? And I truly say that just from a protection purpose. As Bob mentioned about not having the tax tail wag the dog, I firmly believe that specifically in the estate planning area. I think estate planning is necessary, not just for state purposes, federal purposes, but just overall lifestyle purposes and protection purposes. And also from a succession planning purpose. We can't forget about that, especially our business owners. Okay, so now the most exciting part of my section, which I'm going to squish into 5 whole minutes. The pass-through deduction. We can literally spend the morning just talking about the pass-through deduction. Quite frankly, or not talking about the pass-through deduction and just talking about what we don't know and what we still need to know and all the questions that we continue to run into. The pass-through deduction, you'll hear it referred to as the pass-through deduction or the 199 Cap A deduction. Myself and one of my colleagues were running through the deduction, and I know there were people in this room who have done the same thing over the last few weeks, trying to figure out how it was going to pertain to one of our larger clients. An hour later, we were still asking ourselves questions about, for this particular pass-through, is it even going to apply? How do we aggregate? Do we not aggregate? When do we aggregate? What wages can we use? Can't we use those wages because they come from one entity, but they're shared with another? Every layer we had questions, and we kept referring back to acts and articles, and it's just utter craziness. But anyway, I'm going to give it a shot just to at least talk about it so that for those of you who aren't super familiar with what this is, hopefully you'll leave with a little bit of guidance. So very generally speaking, the pass-through deduction is generally going to be 20% of a taxpayer's qualified business income. So that's going to be something else that we're going to hear over the next year. If you hear someone talking about QBI, that's what they're talking about, qualified business income, and how it pertains to this 199 Cap A deduction. And QBI comes from a partnership, an S corporation, or a sole proprietorship, and obviously this is going to be subject to a bunch of limits. This also has to be U.S. based, so this isn't related to foreign entities. QBI is defined as the net amount of items of income, gain, deduction, and loss with respect to a qualified trade or business. And we'll talk about in a little bit what that means. What's interesting is what isn't considered QBI, and this is where we have a lot of gray and a lot of planning. What isn't QBI is certain types of investment income, so interest, dividends, capital gains, reasonable compensation paid to the taxpayer, and guaranteed payments to partners. So you can tell just from that how everyone's minds were lighting up with, so how am I going to plan to get the most QBI? I need to increase my QBI. So many clients were calling me saying, I read articles about, I have to increase my QBI. How do I do that? I'm not taking a salary anymore. I'm going to tell my payroll company, stop paying me. I'm going to have partnership agreements amended. No guaranteed payments for anybody. Everybody's just getting... And you had to say to people, okay, we need to stop. We need to figure this out first before people start changing things. We have to figure out what's the definition of reasonable compensation. If you've been paying yourself $750,000 for the last 10 years, and now you drop that to $100,000, is that going to be a problem? Probably. So we have to work through that kind of stuff. But very generally, that's how this works. Keep in mind, this is a deduction. It's not a credit against your tax. It's a deduction. It's not going to be an above-the-line deduction. This deduction will not impact your adjusted gross income for all the other calculations that take place on tax returns. This deduction, I'm imagining, will be showing up on page 2 of everyone's 1040. But it is a deduction, again, not a credit, and it will not impact adjusted gross income. So there's a bunch of hurdles we have to get over before we even figure out if the pass-through deduction is going to apply to people. The first is this deduction does not apply to anyone in a service-related business or industry. So what does that mean? Again, we find ourselves going back to tax code and reading what is a service-related industry. Very generally, those in the healthcare profession, legal profession, accounting profession, consultants, financial services, not eligible for this deduction. All of those are very broad categories. Is bookkeeping accounting? What is law? If I just, if I'm, just reading contracts, is that law? Is that consulting? And then what we have to take it a step further is a service-related business is one whose principal asset is the reputation or skill of one or more of its employees. That's interesting. Again, there's just more gray that we have to work through, and with no regulation, this is really hard. There are some exceptions out there to this service rule, and that's for engineering and architectural firms. I even found myself doubting that. I have a client who's what do? I go to their website, I read, okay, now exactly what they do, and are they a service industry? And it clearly says they consider themselves engineers. They're product engineers. Is that an engineer? What's the definition of engineer based on Congress? Like, are they thinking about the traditional engineer? Is a product, I also have what they deem, I have an architectural firm. They're not really an architectural firm in the fact that they build skyscrapers or help to build skyscrapers in downtown Manhattan, but to them, they do architecture. It's internal. They do, office layouts and things of that nature. Does that qualify? Again, we need guidance on this stuff so that we can then provide guidance to our clients on what does and does not qualify in these situations.
One of the things that appears to qualify is leasing, because that was a lot of these definitions that Kim's referring to come from another section of the Internal Revenue Code that's been around for a while that deals with an entirely unrelated topic, and that's the exclusion for the gain on sale of a small business company. So a lot of these definitions come out of that. One of the trades or businesses that was listed as being ineligible for that exclusion was leasing. But when they brought that language over into 199 Cap A that Kim refers to for the pass-through deduction, that the word leasing was left out. So is that a drafting error or was that deliberate? So now if you're in the real estate business and you have an operating component and a leasing component, or if you're in a consulting business and you do consulting and you do leasing, do you now want to break those apart to try to maximize this pass-through deduction? Maybe, we think so, but we're not sure yet. But again, this is the kind of confusion that's been laid at our table, if you will, because of the fact that one word was left out, and we have no legislative history, there were no hearings held, there's no committee reports, so we don't know, was that deliberate or was that an accident of drafting, that word leasing was not brought over from this other code section?
And that's another key point, is I keep saying, if it's not something that's mentioned in the Act, go back to the code, and that means that still applies. This is all new. This is completely new, so we don't really have anything to refer back to. So we're really, we're waiting for guidance in order to find out what direction we can go into. Now, there are some people who aren't going to have to worry about certain hurdles, deductions that or caps that we're going to talk about in a second, but also the service industry rules. And if you find yourself working with taxpayers or a taxpayer themselves, married filing joint with taxable income less than $315,000, and other filers with taxable income less than $157,500, it actually gets a little higher. There's some phase outs there for this. It does not matter if they're in a service industry. They can still potentially get this pass-through deduction. So the hurdles are less if your taxable income is less. Again, married filing joint $315,000 and everyone else at $157,500. Whether or not you're in the service industry isn't going to matter. Pass-through deduction may still be available to you. And other things that won't matter at those thresholds will be these wage and capital limitations. So beyond, it's not, again, it can't be as easy as, goodness sakes, you would hope, just 20% of QBI is possibly what you can take as your deduction. No, there's a wage and or capital limitation on this as well. So it's also the greater of 50% of the W-2 wages related to the qualified trader business, or 25% of the W-2 wages related to the qualified trader business, plus 2.5% of a capital element, what I'm calling a capital element, which is very generally undepreciated assets that are placed in service and still being used by the end of the year, 2.5% of those, plus 25% of wages. So what you have to think about is, okay, first and foremost, am I dealing with a taxpayer that's under the taxable income limitations? Oh, and think of it, I think of it as a flow chart. Other people up here have referred to it as a Rubik's Cube, and we've seen it a variety of different ways. But all right, am I over or under that limit? Am I under the limit? Great, I can move forward, and now I just have to worry about what my overall taxable income is, and can I get this deduction? If I'm over it, now I have to worry about these wage and capital limitations. And if the wage and capital limitations are less than my 20% of QBI, I'm going to be limited to that. So we have to worry about that too. And then once we figure that component out, we now have to compare all of it to 20%, generally 20% of our taxable income less capital gain income. So there's all these different thresholds we have to get over before we can even figure out whether or not the deduction is going to apply to us or to our clients. So it's interesting. There's software that's coming out right now that's supposed to help with this. There's other software that doesn't even want to take a stab at it. So you calculate it, on an Excel spreadsheet and drop it in yourself, because there's just not a lot of guidance, and there's, so much that still needs to be sorted out. So I'm going to leave it at that, because I've probably already gone over my time. And Mike is going to talk for a bit about changes for businesses.
And in that regard, there's one thing I wanted to add to the pass-through deduction, because you're going to start seeing articles coming out about possible additional benefits from that. There are two other types of flow-through entities that are eligible for the 20% deduction without any of the other limitations that Kim was talking about. One is dividends from real estate investment trusts. So you might start hearing or reading articles about these real estate investment partnerships all of a sudden reorganizing into private real estate investment trusts to essentially eliminate this whole issue of, do I have wages, do I have capital, do I have enough, because it's just eligible for the 20% deduction right off the top. Similarly, and this was a last-minute addition to the bill, cooperative patronage dividends are eligible for the 20% deduction. You say, well, how does that affect me? Well, it was originally stuck in there to get the votes for senators in a couple of farm states. It has the large agricultural companies like Archer Daniels Midland and people like that up in arms because it creates an incentive for farmers to sell their product to co-ops and joint co-ops as opposed to being, selling to these major producers. An example of a farm co-op is Ocean Spray Cranberry Juice. Ocean Spray Cranberry Juice is a co-op, or cranberries in general. All the cranberry growers are members of this co-op, and they contribute their berries to the co-op, and they vote on what products to make and the advertising and all that. And at the end of the year, they share the profits in the form of patronage dividends. Those patronage dividends are now eligible for the 20% deduction. And you're saying, well, still, how does this affect me? Well, there's some discussion out there about, if I've got a law firm or an accounting firm, maybe I want to be a co-op. And I can reorganize, I can incorporate, I can set it up as a co-op, I follow all the rules for cooperative corporations, and at the end of the year, I just give everybody a patronage dividend. And now, notwithstanding the fact that it's a disqualified business under the normal rules, I've got a possibility of qualifying all my income for 20% without any of the other limitations. So you're going to start seeing articles, you're going to start seeing people talking about these ideas. It's not clear to me, and I'm probably one of the more aggressive people at the table. It's not clear to me whether those things will work, but we should have conversations about this because there are these little hidden opportunities. Are they drafting errors? Are they deliberate loopholes? Are they just the result of a rushed process to begin with? There are these little things hiding in there that may make it possible to do some creative planning. I'll add one more before I get onto the business thing about the state and local tax deduction. So tell me if I'm boring you. But there's a question out there about whether if you're in a pass-through entity, a partnership, a sole proprietorship, an S corporation, whether the state and local taxes on your trade or business income should still be deductible. I mean, they are if you're a corporation. The state and local taxes are deductible at the corporate level. So in the sense that part of the goal of all of this tax reform, and you notice the word reform never appeared in the bill's title, but the whole point of this tax reform was to make people indifferent between choices of business entity, whether you're a corporation or a partnership or an S corp. You were supposed to make those decisions independent of the tax ramifications. So here's how the argument goes. Back in 1939, when I was young, the tax code included a provision that said that state and local taxes of proprietors were not deductible except as itemized deductions. And that continued into the 1954 code, and there were regulations written on the subject, and that was all well and good. So we had a 39 code, all new, fine, you can't do it. 54 code, all new, you can't do it. Regulations said you can't do it. The 86 code, remember in 86 we rewrote the entire tax code. Unlike now, they threw out everything from 54 plus all the changes in the intervening years, wrote a whole new tax code. So we have this whole new tax code, doesn't contain that provision, and the regulation that said that proprietors and owners of pass-through entities couldn't deduct their state and local taxes was withdrawn. Okay. A temporary reg to that effect was put into the rules in 1992, but temporary regulations expire after 3 years. So that regulation expired in 1995. So there is now no authoritative guidance under the Internal Revenue Code of 1986, which is still our code, that says that sole proprietors, partnerships, S corps can't deduct their state and local taxes attributable to the trade or business on the Schedule E or Schedule C, wherever they report that income. Now, it's an aggressive position. But again, this is the kind of thing that you're going to start seeing because other than a couple of old cases from the 50s that were decided under old law, there technically is no guidance that says that you can't do that. Why weren't we doing it all along? Because people didn't really care. It was on a Schedule A. Nobody wanted to fight the battle. Unless you were in the AMT, it didn't really affect you all that much. So it wasn't the kind of thing that really drew anybody's attention. Now we're drilling down to all this arcana that's been hanging around in you know, like I said, the tax weeds for years. But these are the kinds of discussions you're going to start seeing. And, you know, is it inadvertent because of quick drafting, or is it deliberate? Who knows? We'll find out. Another thing, the likely thing that you're going to see on the pass-through deduction, the IRS's guidance is likely to come in the form of Q&A. They're doing that in a number of areas. They're doing that in international. Ryan's going to talk about that. They have a group now that is collecting questions. If you have any, we're in touch with them. If you have any specific questions that you want us to relay, we can do that. But they're collecting all these questions from practitioners, and they're going to come out with, you know, a publication that's basically questions and answers on Section 199 Cap A. It will likely be something that taxpayers can rely on, but it will only be something taxpayers can rely on if it explicitly says that. So if you're following along, you know, playing the home version of this, definitely look for those words, because if it doesn't say that it's a reliance notice, then it's just, you know, nice guidance from the IRS, but nothing you can rely on. So, okay, so moving on to corporate taxes. You've all heard that the corporate tax rate has been reduced to 21% permanently. Permanent is a relative term in Congress. I've never seen, you know, in all the years I've been doing this, anything be permanent, but it's permanent temporarily. And that's for tax years that begin after 12/31/17. So the question came up, well, what if I'm a fiscal year filer? What if I'm on a fiscal year? It turns out that there's always been guidance in the Internal Revenue Code as to how fiscal year filers handle the change in rate. For those of you who care about these things, it's Code Section 15, and basically speaking, it's one of the simplest sections of the code. You prorate. If you're in the retail business and you've got a 52, 53-week year, you can prorate as long as your year doesn't end within 7 days of the effective date of the rate change. But otherwise, you're just looking at a straight proration. If you're in a personal service corporation, good news, the special rate for personal service corporations is gone. As Kim alluded to, the corporate AMT is gone. There's some changes to dividend received deductions. That's only relevant to people who are in certain types of corporate consolidated groups, so we're not going to go into all of that detail. But I will point something out. So Orrin Hatch, who is still the chairman of the Senate Finance Committee until he retires at the end of the year, has been a huge proponent of something called corporate integration. Corporate integration does not deal with, you know, making more women and minorities directors and shareholders. Corporate integration has to do with something called the dividends paid deduction. The problem is that corporations, as most of us know, you wind up paying two levels of tax. The corporation pays its own tax, and then the shareholders pay tax on the dividends that they receive. So it's basically a tax inefficient vehicle. The idea of reducing the rate was to accommodate that somewhat, but it's still somewhat tax inefficient because net, if you have a C corporation at the 21% rate, and then you pay out dividends that are basically at 23.8% rate, you know, in the highest brackets, you're looking at a 39 to 40% effective federal rate, which is still higher than the highest individual rate. So Hatch's idea is that he wants to give corporations a dividend paid deduction. Those of you who work with real estate investment trusts know that they have that. Mutual funds have that. That's how those vehicles become essentially tax-free. They get to deduct all the dividends that they pay out. So one iteration of the bill, Hatch actually had a dividend paid deduction in the Senate bill. It was just at a 0% rate. I've been looking for that language. I haven't seen it. It seems to have been struck from the bill. But listen for that over the course of the year while he's still in the Senate Finance Committee. Listen for talk about a dividend paid deduction. Because to the extent that he can get that in, and you can deduct, corporations can deduct 20% or 30% or 50%, now you're looking at a scenario where the overall effective rate of owning a corporation will be roughly the same as the overall effective rate of using a pass-through entity like a partnership or an S corporation. And so that's going to have an impact on planning. Again, and I can't stress this enough, we've had a lot of people say, well, I want to get that lower corporate rate, I'm going to incorporate all my partnerships. It's real easy, as Bob said, to get into something. It's real easy to get into a corporation. It is really hard to get out. And you'd say, well, I'll just make an S election. Remind people about the built-in gains tax, which over the years Congress has played with as well. Don't rely on anything to be permanent, so just make sure that if you're making changes to your corporate structure, you think about, do I have an off-ramp? Do I have a way to get out of this if and when things change? Because it's not a question of if, things will change. Congress is addicted to playing with the tax code.
No,
Mike?
I'm
go
sorry.
ahead,
Bob.
go ahead.
I was just going to interject, and another thing, as we alluded to before, don't forget about the state tax implications, even at the corporate level. And I apologize, Pennsylvania person sitting here in the room, Pennsylvania has a huge corporate net income tax, 10%. That's a big number, and it's not something that you want to forget about if you're doing planning or you're planning to do any type of restructuring. State taxes didn't change here.
Mike, do you think that with the lowering of the tax rates at the corporate level, that that's going to affect what employers put in the form of pension and profit-sharing contributions for their employees?
I think there's going to be a lot of unintended consequences. That's just one of them. You were talking, so there's employee benefits, corporate charitable contributions. We'll talk a little bit later about the low-income housing tax credit, but one of the big concerns is for those that are developers of low-income housing and are reliant on the low-income housing tax credit to raise capital. It's going to have a huge impact because the whole pricing model is built on the corporate tax benefit. Those of you who are unfamiliar with the low-income housing tax credit came in 1986, provides a significant economic boost, a significant source of capital. Because of the passive activity rules that also came in 86, almost all the low-income housing tax credits are bought by corporations. They have a much lower incentive now, or the pricing is going to have to change, which is going to make the economics of the deals significantly more difficult for developers of low-income housing. So there's a whole, and this is one of the wonderful things about this particular bill, is that there are a whole host of unintended consequences. So there's three right there. Employee benefits, probably going to change where there's a possibility to do that. The price of low-income housing tax credits is going to drop, so less capital available for that. And corporate charitable giving, I think, is going to take a significant hit because, again, there's much less benefit for it. On the other hand, we've seen some corporations already say they're going to give bonuses. I think what you're actually going to see is a lot more in the way of stock buybacks. I think you're going to see a lot more, a lot of changes in dividend rates. Really, to peel that back, what's important is to look behind. There's been a lot of talk about Elon Musk at Tesla, about his new compensation regime. But, peel back in any corporation and find out what the top executives' compensation plan is based on. Is it based on earnings per share? Is it based on stock price? Things like that. And that's going to have an effect on whether they pay more dividends or whether they buy back stock, because they're going to be looking, essentially to follow their own pay. As long as we're talking about executive pay, that's another area that's been significantly affected. There is a provision in the code that says that pay to the top 5 executives that exceeds $1 million is not deductible unless it's performance-based. So, sales or some other metric, or it's some kind of a commission. That exclusion has been taken out. So now there's just a straight $1 million limitation on executive compensation. So if you're heavily invested in corporations or you're active in one, you'll start to see more creative forms of compensation for executives to try to get around that limit. Accounting methods, something really exciting to talk about. There are a number of different provisions in the code that deal with what we call accounting methods. So can I be on the cash method or the accrual method? Do I have to capitalize production costs if I'm a manufacturer or certain other industries? Do I have to use the percentage of completion method for contracts, or can I use just the complete, recognize my income on completion? And they all had different measurements of when you could use it. Those have now all been unified. So there's now a $25 million threshold, average 3-year gross receipts. It's also the same threshold for the interest expense limitation I'm going to talk about in a minute. So that also leads to a planning opportunity. So now if I was on the accrual method, or I was using inventories, and now I'm under that $25 million cap, I might want to change my accounting method. We don't know yet how to do that. Is it going to be an automatic method change, or do we have to apply for permission? Do we use what we call a 481A adjustment, which says that I can take, if there's a net negative change, I can deduct it all in the current year, but if it's a positive change, I can spread it over 4 years. None of this guidance is out there, but if you want to make, accounting method changes for the current year, it's got to be done and it's got to be planned for. So again, we'll wait for guidance on that, but something to think about if you're under that threshold. Interest deduction limitation. Okay, so this is, again, Congress's attempt at macroeconomic planning. They're trying to make companies indifferent between raising equity or borrowing money. So they said, how can we do this? Well, initially they were just going to get rid of interest deduction altogether. You couldn't deduct interest whatsoever. And needless to say, there were a number of industries that were significantly affected by that, farming and auto dealers in particular, but real estate and a few others. So they carved it out, and carving it out made it a lot more complicated. If you're an auto dealer, it's really simple. You pretty much get to deduct all your interest. If you're a farmer or in the real estate business, you can elect out. For everybody else, again, there's this average annual gross receipts test. What we don't know is what happens if I have 5 businesses and each one has $6 million of gross receipts. Do I have, and they're all corporations. Do I have to aggregate those? Do I have to split those? Because I own 100% of all 6 corporations. Or conversely, if I've got one corporation that's got $25 million or more than $25 million, can I split it up, and get underneath that limitation for all the businesses? So again, no guidance, but essentially you're limited to 30% of your earnings before interest, taxes, depreciation, and amortization for now. In 3 years, depreciation and amortization come back in. So that's the limitation, 30%. The disallowed interest is carried forward indefinitely. I guess they're assuming some point you'll pay off your debt and you won't have interest expense anymore. Never seen a business actually do that. But, in Congress, they know so much about this. It applies to tax years beginning after December 31, 2017, so it's in play now. If you are in the real estate business and you decide that you want to take advantage of the exclusion, you have to elect what's called the alternate depreciation system. I'll talk a little bit more about depreciation in a minute, but essentially the alternate depreciation system just means your depreciation is a little longer. So if you have a commercial building, instead of 39 years, it's 40 years. If you've got a residential building, instead of 27 and a half years, it's 30 years. That's a new change. Used to go to 40. But if you've got tax-exempt investors, they may want you to do this anyway. If you're a real estate investment trust, you're already using ADS to compute earnings and profits to determine what's a dividend and what isn't. So it's really not that big a give up for most real estate businesses to do this, except for one thing. If you elect ADS, you're not eligible for bonus depreciation. And bonus depreciation has gotten really generous for the moment. We'll get to that in a minute. 2 other little things that I want to talk about: net operating losses. For net operating losses that arise after 2017, you can only use 80% of that against 80% of your taxable income can be absorbed by an NOL. It carries forward indefinitely, but there's no carryback provision. Net operating losses from prior years aren't limited. Now, there's one other, again, we don't know if this is a drafting quirk or if this was intended, but there are one of the limitations on deductibility, I lost my train of thought. I'll get back to it. Excuse me. I'll get back to that one in a minute. All right. One other thing that was important that Congress came up with, contributions to capital. Again, originally they were going to apply this to partnerships and S-corps. It's now limited just to C corporations. But if you do have a C corporation and some state or municipality, I'm sorry. If you have a corporation and some state or municipality wants to give you money to move to their location, that's now going to be taxable income. It's got a weird effective date. It's effective for contributions made after December 22nd, which is the date of enactment of the bill. So cost recovery provisions. Section 179, the limit is increased to $1 million, and it phases out at $2.5 million, and they've added a whole bunch of categories of qualified real property. So it's all qualified improvement property now qualifies for expensing. Roofs, heating, ventilation, air conditioning, fire protection, alarm systems, and security systems to non-residential real property also qualify for expensing under Section 179. If that list sounds familiar to any of you, all of you who worked on with the tangible property regulations a couple of years ago, the so-called repair regs, those are the other 7 units of property. So they've now all been specifically added. An important caveat on this, Section 179 is not a depreciation section, it's an expensing section. So if you expense property under Section 179, it doesn't come into play for the capital portion of the limitation on the pass-through deduction. Following me so far? So 179 is an expense. I can write it off, it's great, I love it, but I don't get to include that in the base for the 2.5%. Depreciable lives have been changed. Qualified improvement property, remember we used to have qualified restaurant property, qualified leasehold improvement property, qualified retail property. Those have all been eliminated. It's just called qualified improvement property. In theory, it has a life of 15 years. The problem is the way they drafted the law, the section of the code that they refer to for the life of the qualified improvement property is a section they repealed. So it should have a life of 15 years. We expect some kind of fix on that, but right now it doesn't. And again, the ADS life for qualified improvement property is 20 years, residential property is 30 years, and that applies to all property placed in service after December 31, 2017. So older properties are going to still be subject to the longer ADS lives. So that raises the question, if I make the election to use ADS for purposes of avoiding the 30% limitation on interest deduction, exactly which ADS life do I use? And we don't know. But we'll get back to you before the end of the year, hopefully. Bonus depreciation, 100% bonus for property placed in service after September 27, 2017. So now you have to decide between, is it a repair? And I deduct it or I can capitalize it. If it's not a repair, do I take 179? Am I eligible for 179? Or do I capitalize it and take bonus depreciation? If you had a binding contract or you acquired the property but hadn't placed it in service before that date, it's probably not eligible. But again, that's one of those sections that's not entirely clear. The big change for bonus is that used property is eligible. So in other words, if you buy something that had already been placed in service by somebody else, it's still eligible for bonus depreciation, which raises another deep in the tax weeds question for us. Those of you who are in partnerships and know about partnership transfers and know that there's something called a Section 754 election, which when you buy a partnership interest, it allows you to adjust the basis of the partnership's assets. Is that now eligible for bonus depreciation? The answer, I think, is yes. But again, I don't think that was intended. But that asset is actually considered an asset in the hands of the partner, not the partnership, so it's acquired. It's used, but it should be eligible. Also, any of you in the theatrical business, if you made a film or a TV show or you put on a stage show, that's also eligible for bonus depreciation now. If you use a car for business and you have a luxury car, Those limits have been significantly increased. You can effectively recover about over $40,000 in the first 4 years of owning the car. So that's all pretty good stuff. Tax credits. The new markets tax credit is still around. I don't know for how long, but if you work in the new markets tax credit area, you can still take advantage of it. Similarly with the low-income housing tax credit, but again, I think that there's going to be a significant impact on what people are willing to, what corporations are people too, what corporations are willing to pay for low-income housing tax credits. The rehab credit, those of you who do rehab work, the historic rehab credit is still around, the 20% credit. But if you were taking the 10% credit on buildings that were built before 1936, that is now gone. And there's been a significant change to the 20% rehab credit that you have to take over 5 years instead of taking it all at once. So again, combine that, most of the rehab credit, a lot of the rehab credits were bought by corporations. They're often done in conjunction with the low-income housing tax credit or in conjunction with moving to a new location. That's going to be significantly affected as well. 1031 exchanges. 1031 exchanges are now limited to real estate and real estate only. So if you were buying art and you sold it and you wanted to roll over the gain into a new piece of art, you can't do that. Similarly with airplanes. If you had a corporate jet and you sold it and you were going to trade that in, or a corporate car or a piece of equipment, any of those things, you trade in cars all the time that are used in business. If it's got a fair market value in excess of your basis, you're now going to have to pay tax on that gain because it's not eligible for tax-free exchange. How many, just show of hands, how many people knew that trading in a car was a 1031 exchange? Okay, I got Dave Schneeman in the back of the room. Thanks, David. So anyhow, so there's all these unintended consequences. Now, Congress has been trying to get rid of 1031 for years. Real estate had a very good lobby, and it stayed in.
Sounds like real estate did quite well under this new tax law.
Real estate, surprisingly, did quite well in this deal.
Wonder why.
One area where it didn't is in certain tax-exempt bonds. Those of you who work with something called advance refunding know that what would often happen is projects would borrow at a high tax rate, tax-exempt bonds funded by a municipality or state government, something like that. They would go out and issue advance refunding bonds, so they'd raise money 3 or 4 years before they could actually pay it off, invest that in treasury bonds, and just have the money parked there at a lower interest rate when lower rates were available. That's now not eligible for tax-exempt status. So advance refunding bonds are not going to enjoy tax-exempt status. We already have some planning ideas around that. So if that's something that affects you, see me after the show, and we can talk about how to get around that. And with that, I'm going to let Ryan tell you the really exciting part, which is that if you have money parked overseas, it's time to bring it home.
Thanks, Mike. So, who's heard the phrase the tax code is broken? Prior to December, we heard that pretty regularly, and well, I think that was probably a bit of an overstatement for the domestic rules, and definitely nothing in the new legislation would change that. On the international side of things, the tax code was definitely broken and definitely out of date. So a lot has actually changed. Some of the things that have changed have already been covered off on the domestic side of things. Mike mentioned, for example, that the tax rate for corporations was reduced to 21%. One of the major drivers of that is the US's position in terms of corporate taxes in the world. In 2016, there was a survey of 188 countries, and the US came third out of 188, third highest tax rate in the world in terms of the corporate rate. The countries that had worse rates than the US included United Arab Emirates, whose tax rate is higher but only applies to oil and banking industries, and Puerto Rico. So really none of the US's competitor countries, let's call them, had a tax rate higher than the US. So bringing it down to 21% pretty much brings it in line with the average, which was about 22% from that survey. Now that's important because it changes the whole emphasis of where you want to be doing business and where you want to expand, where you want to basically generate your profits. Whenever a company is investing into the US or a US company is investing overseas, they have some control over where they're going to recognise their profits. It's not an unfettered control, but they have some control over it. And so we now have a situation where in November, if a foreign investor, a foreign company wanted to distribute goods in the US, we would structure it in a way that the US company might make a very small margin and pay lots of taxes on that. And all the profits, of course, would go to the home jurisdiction. Now we're in a situation where we may have the opposite, where we're saying, no, let's put as much profit as possible into that US distributor and leave as little money as little profit as possible in the other jurisdiction, because the other jurisdiction has the higher tax rate. So in relation to all of our distributor clients, all of whether it's inbound or outbound, anyone that has used offshore contract manufacturing, any of these sorts of arrangements, even determining what is the appropriate interest rate on an intercompany loan that goes cross-border, is now up for re-evaluation to determine, hey, where do we really want these profits to arise? And that's not just limited to corporations, I might add. To the extent that there might be any qualified business income, this can affect individuals as well who have investments offshore, whether they want to keep their profits in an offshore company or bring it back if it might qualify for that additional deduction that Kim mentioned. So that was one very important improvement in the overall competitiveness of the US tax code. The other really significant improvement in the competitiveness of the US tax code, again for corporations, is a new participation exemption. Now this is only available for corporations, it is not available to individuals. But where a corporation owns 10%, a C Corp owns 10% or more of a foreign corporation and it receives a dividend from that corporation, they're now going to be entitled to a deduction equal to 100% of that dividend. So basically, dividends coming from offshore corporations where you meet that 10% ownership threshold are now going to be tax-free to the US corporations. Previously, what a US corporation had to do was recognise the income. They might get a credit for the taxes that might have been paid overseas, but then they had to pay the incremental tax. So if, for example, the offshore company had paid 10% tax in the jurisdiction it was operating in, pays a dividend, the US company would get a credit for the 10% but have a 35% liability, and so have an incremental liability of 25%. Needless to say, that's why we saw so many profits of the larger corporations, household names, the Apples, the Pfizers, Citibanks, etc., accumulate offshore. I think we were approaching the $3 trillion mark in terms of offshore money. With a participation exemption, the benefit of holding that money offshore is substantially reduced, in fact, substantially eliminated other than for state and local purposes. And so we would expect that a large portion of that money will be coming back to the US. The introduction of the participation exemption, though, is also important in that it is a fundamental shift in policy. So for the last 60 years, for the policy wonks, capital export neutrality has been the basis on which the US international taxing regime has been founded. With the adoption of this change, effectively capital export neutrality has been thrown out out the window. So it is quite an important shift, and it gives us a good indication that the US government is now joining the race with other countries to make sure it gets its share of the global revenue pool, and let's just say the US is now open for business. Now, before you can shift to a participation exemption whereby companies can bring back all their profits without paying any taxes on the dividends, you need to have some degree of transition. It would be inappropriate, I think we'd all agree, if companies kept their $3 trillion offshore, paid no tax on it, and then just by virtue of waiting out the clock, get the benefit of this participation exemption. So there is a mandatory income inclusion of the accumulated earnings. This is a new rule, sometimes referred to as the toll charge, that basically says if you own a particular type of interest in an offshore company, you have to pay tax on the accumulated earnings of that company, and you have to pay them this needs to be reflected in your 2017 income tax return. Most of the changes that we've been talking about today are going to affect your 2018 income tax return. So that's the money that you're making now, the deductions that you're incurring now. In relation to the toll charge, that's actually going to affect last year's tax return. It's going to be reflected on tax returns that may be filed in April 15. And there are actually some elections, and a particular election that needs to be made by April 15, which we'll get to in a second. But the idea behind the toll charge is that it applies to all of the income other than certain types of income that have already been subject to high rates of tax. It only applies to income after 1986, and the way that it is calculated is that you take that post-86 income that hasn't been subject to the various types of high rates of tax, which we'll ignore just for the moment, but you take that income, you look at the balance sheet of the offshore company, and to the extent that the offshore company has cash or highly liquid assets, that amount will be subject to tax at 15.5%. Any additional earnings will be subject to tax at 8%. That tax liability, once it's computed, is then paid, subject to making an election by April 15, is paid over an 8-year period. 8% per year for the first 5 years, then 15, 20, 25%. So the effect of this is that you might only be paying 8% tax on offshore earnings, and you'll get to spread that tax obligation over an 8-year period. So it is a fairly concessional regime, and once those earnings have been subject to that mandatory income inclusion, then they won't be subject to tax again. So this is a one-time hit, again spread over 8 years. Now, the taxpayers that are going to be affected by this, you would assume, would include US corporations that have a 10% or greater interest in a foreign corporation, because they're going to enjoy the participation exemption as well. You'd be absolutely correct. But it also applies to individuals in certain circumstances, the most common being an individual who has a 10% interest in a controlled foreign corporation. And there are also certain other rules for corporations that have 10% corporate shareholders that may also draw in US individuals that have a 10% interest in that company as well, even if it's not a controlled foreign corporation. But for individuals that have a 10% interest in the CFC, they are also subject to this regime, even though they may not get the benefit of a participation exemption. Still, this regime is concessional to those taxpayers in that they will pay the tax, regardless of whether the amount is distributed, But when the amount does get distributed, it will be treated as previously taxed income, which means that it won't be subject to tax again in their hands. So that's a reasonably attractive concession. Okay. So just a reminder, that is one rule that people do need to be aware of before April 15 of this year. Some other things that occurred as well, other important things. The US has its control foreign corporation regime, Subpart F, that many of you may have come across. Subpart F is substantially intact. They didn't do away with Subpart F even though they introduced the participation exemption. In fact, they, in some respects, expanded it. It now applies to, they will now treat a US person that has a 10% value interest in an offshore corporation as a US shareholder subject to these rules. Previously you had to have a 10% voting interest. Now it's vote or value. There was a 30-day rule. If a foreign corporation wasn't a CFC for 30 days, then it would basically be not be subject to these to Subpart F. That 30-day rule is gone. And the attribution rules have been expanded to attribute more ownership. So Subpart F in some respects has actually been expanded. But the biggest change to Subpart F is the introduction of a new regime called the Global Intangible Low Taxed Income regime. The acronym for Global Intangible Low Taxed Income is GILTI. That was probably by design. I'm sure many congressmen or their assistants spend hours trying to figure out an appropriate term. But this is the sort of income, well, if we take a step back, Subpart F was always based on the qualitative character of the income. If the income was easily transportable to a foreign jurisdiction, the US government wanted to tax it because they didn't want people just artificially shifting profits overseas. But if the income really belonged overseas, then it should be left alone. GILTI does away with that qualitative distinction. GILTI says if the income isn't subject to a certain rate of tax, then we're going to basically tax it in the US. So that's the effect of GILTI. And the way that GILTI works is, again, GILTI excludes certain income that has been highly taxed, whether it's already taxed in the US under other parts of Subpart F, or it's taxed as effectively connected to the US, or it's subject just to a very high foreign tax rate. So that income is excluded. You are then allowed a deduction equal to 10% of the depreciable assets of the offshore corporation. So for distributors who don't have any such assets, or people that use contract manufacturers, again, probably don't have any depreciable assets overseas, that does very little. The rest of the amount is considered GILTI, and that's included in the income of the US taxpayer. In the case of an individual, they could be subject to tax at the full rate, so that's 37% in relation to that GILTI income.
Hey, Ryan, for years you've been telling people to move their intangibles offshore. Now are you going to tell them to put them back onshore?
So yes, between the GILTI regime and the FDII regime, which I'll touch on in just a second, there may actually be incentives to keep intangibles and the income arising from the intangibles in the US. So rather than the standard planning up until now has been move IP offshore, move portable income offshore as quickly as possible, because pretty much everywhere offshore was going to give you a better tax rate than the US. Now the US, first of all, it's going to go after that income. So that income is going to be subject to tax at somewhere between 10.5% and 13.125% in the hands of a corporation, and up to 37% in the hands of an individual. So the incentive to move it to Ireland, where you might pay 12.5%, is substantially reduced. So yeah, this will affect IP planning very significantly.
Ryan,
Yep.
I think we need to wrap it up as soon as you can, because we got a lot of questions. I want to get to as
Sure.
many as we can.
Sure. I suppose so there's a whole bunch of other changes from the international perspective, but perhaps the one other area that that was introduced in the legislation relates to the new foreign-derived intangible income regime, or FDII. With FDII, it has very little to do with intangibles. It's just that they deduct an amount associated with the tangibles. But to the extent that you could be selling goods to foreign people for consumption overseas, to the extent that you could be generating income from offshore, FDII will provide a new deduction of 37.5%, effectively only to corporations, not to individuals, but that has the potential to drive the corporate tax rate from the 21% down to 13.125%. So for those businesses that were traditionally done through foreign subsidiaries, they may now look to bring those activities back under the umbrella of the US company, have the US company derive that foreign income with a view that it's only going to suffer tax in the US at 13.125, which is, again, very competitive with global rates. I've got a lot of other things that we could be talking about, but we might be here for another 5 or 6 hours, so I'll pass it back to Bob.
Right, and I want to adhere to our time schedule, and we're going to fire through these questions. One person would like to know if, in view of the $10,000 state tax limitation, if we plan to consider married filing separately for a number of our clients to get two $10,000 state income tax deductions.
Congress took care of that question for us. If you filed married filing separate, it's $5,000. So no 10 and 10.
Question here, what will the process look like going forward to ensure your clients are in line with the new rules? Well, we've formed a committee of 7 professionals who are dealing with the new tax law. We have a partner and principal tax call every Monday morning from 9:30 to 10:30, discussing nothing but the new tax law and what the planning and compliance implications are. Mike mentioned our liaison with on the pass-throughs with Washington and the IRS, that we have a special committee we can get answers from. They'll entertain our questions. And we're constantly sending out client alerts. We're educating our staff so that they'll be aware. And we will be in touch with people from time to time as we get new developments. Does co-op shareholders still have to look at the $750,000 mortgage interest limitation? I believe the answer is yes.
I mean, the $750,000 limitation is going to apply regardless. It'll just be, we'll just have to look through, because from a co-op perspective, the way the co-ops normally work is you purchase units within the co-op, and then based on the units that you own, that's what your mortgage interest is that's allocated to you, as well as your real estate taxes. So, but the same rules will apply as have always applied. So yes, it still will.
Kim, are medical professionals allowed to take the 20% deduction?
No.
But that raises an interesting
Mike
question.
always has a but. That came out wrong, but nonetheless.
If you've got, yeah, and believe me, it's not my best side.
Moving on.
There are rulings out there on ancillary healthcare activities related to medical practice and whether those in a similar context are eligible. So if you've got a medical practice or something like that, you might want to unbundle things like billing and other activities and create those as profit centers, because those ancillary activities probably are eligible for the 20% deduction, even though the actual practice of medicine or actual provision of health care is not. All that other stuff that goes on behind the scenes probably is, so you might want to unpack that and create a bunch of different businesses.
The so-called packing and cracking strategy.
Yeah.
And you just answered another question, so I can skip that one, but you don't get off the hook. Is real estate rental net income qualified business income?
Is real estate rental net income qualified business income? Yes.
No buts.
No buts.
No buts.
Past major tax
Well,
bill.
actually, I'll take that back.
I knew it.
I'll take that back. So the question came up, if you've got a triple net lease property, so you basically don't have to do anything, you just collect rents, it's like collecting a bond. Is that a trade or business? And the answer typically has been, no, it's not, because you're not active, there's nothing that you have to do to manage that property. Take it to the next step. If you have 100 triple net lease properties, is that a trade or business? Well, now maybe, because you've got, so the question on real estate rental income turns on whether or not your rental real estate activity is in fact a trade or business. Not passive or active relative to the passive activity loss rules in section 469, but is it in fact, does it rise to the level of being a trade or business, or is it an investment? And that's going to turn on how much activity is actually involved in managing the business. Now, hiring a property manager doesn't make it not a trade or business, the fact that you hire other professionals, but it's just going to be a question of whether or not the level of business activity rises above what's required for investment purposes as opposed to being an active trade or business.
Another question is, can the new Section 199A deduction create a net operating loss to carry forward? I believe the answer is no.
No, it's because it's limited to 20% of taxable income, so it could never in and of itself create a net operating loss carried forward.
But, okay, let's take it a step further. What if,
Oh, you have a butt this time.
so now I'm asking a question to you.
Okay.
So if I have a deduction, and my deduction is greater than my 20% of taxable income limitation, so I have that excess,
Right.
do I get to carry that forward?
No, there's no carry forward provision in 199 Cap A.
So it doesn't work like, I compare 199A to the old Q-pad, or the D-pad,
Right.
right? That there were carry forward
199,
provisions.
yeah, and it's based a lot on the old 199 domestic
Right.
production activity deduction, but it doesn't appear to have a carry forward. There is, we didn't really touch on this very much, there's an excess business loss provision. It's in another section, it's section 461, to keep moving these things around, which says that if you have over $500,000 of excess business losses, in other words, all the income that you have from your trades or businesses, and you look at all the losses that you have from other trades or businesses, you can only use $500,000 of the excess of the losses over the income against other non-business. In the past, you could just use it all and wipe out wages or investment income or anything like that. So now there's a limitation on that. That has a carryover provision.
Mm-hmm.
So in other words, any of the excess business losses above $500,000 carry forward. Interestingly enough, the section that they drafted says that it carries forward as a net operating loss. So now here's a question for you. Was that deliberate or was it a drafting error? Because net operating losses don't appear to be subject to this overall computation of excess business losses. They're not included in the definition of a business loss. They're just a carry forward from a prior year into the current year. So effectively, I've got, if I've got all these excess business losses, I carry them over to the next year as a net operating loss, and I can use them up to 80% of my taxable income. So maybe I'm not really harmed by this provision, or maybe they just messed up the drafting.
And the last question for anybody on the panel that we have time for right now, I remind everybody we will be sticking around for some time afterwards to take individual questions if you still want to consult with any one of us. Past major tax bills took a long time to negotiate and draft. 2 years from start to finish for the Tax Reform Act of '86. You might not have liked the provision, but at least it was drafted by staff who understood the tax policy behind the provision and the implications for other parts of the Internal Revenue Code. The common perception of TCJA is that it was thrown together by people who weren't as experienced and don't understand the implications of what they were doing. Your view?
That is my view. I wrote that question. No. So actually, the Tax Reform Act of 1986 took more than 2 years. It took about 4 years. to be drafted. We have massive committee reports and hearings and studies by the Treasury Department. Treasury 1 came out in 84, Treasury 2 came out in 85. The analogy I like to give is an art one. You know, we've all seen the famous painting of Washington crossing the Delaware. It's very elaborate. It's got a lot of mistakes in it. It's got some errors. The general would never be standing in the boat, first of all, and he wouldn't be in the front of the boat. But at least we can all agree on what it represents. It's a painting, Washington crossing the Delaware with his troops, blah, blah, blah. It's detailed. We can figure it out. The new Tax Act, which technically isn't called the TCJA, it's got a name that goes on for about 15 pages, is more like a Jackson Pollock painting. We all know it's paint on canvas. After that, we have no idea what it actually represents. And what you might think it represents would be different than what I might think it represents. Some people think it's just, you know.
So here's what Mike's referring to. Here's the initial picture that he's referring to. Here's the second picture, the Jackson Pollock picture. Now, here's the inside joke from earlier. He showed me this, and I'm like, oh, it's a pile of mud. Or it looks like, again, in the summertime, I make a s'more dessert. Looks just like this. I'm like, or it's my s'more dessert. He looked at me like I was a fool, then proceeded to tell me how this was Jackson Pollock artwork. But still, to his point, it is not clear what it is, just like the Tax Act.
Right.
And with that visual, I thank you all for joining us today. Have a great day. Thank you.